Well, greetings, good evening, and welcome, investors, to the September 2022 Roundtable. My name is Mark Robertson. I am joined here by my dear colleague, Ken Kavula. Good afternoon, sir, or good evening, sir.
Yeah, good evening. How are you? It's getting dark really early now, so it's completely dark here right now. Hasn't been true this whole summer, but it's dark now.
Well, I consider myself, and I am, grateful. We're going to be short-staffed here tonight because we have one person basically battening down the hatches for a hurricane. That would be Kim, getting ready for Hurricane Ian down in Florida. We have another one of our typical representatives. Cy Lynch is out herding cats in Utah. So I'll leave the herding of the cats to him. And
Sai has done this cat rescue thing now for what, maybe a dozen or more years, Mark?
yeah, it's a national program that he and his wife are very active in, and it's basically feline refuge on a national scale. So lots of good work over the years. And we had hoped that Hugh could join us tonight, but he was pulled away. So you're stuck with two guys out there in the audience. But we're glad to be here. We talked a little bit about it this afternoon, but I think the general theme that we're certainly striking lately is this notion, and it's on the cover page here. This is an accumulation opportunity. This is a tough market. There's no doubt about it. I mean, things are getting hammered. It may continue. It could rebound. A lot of times it depends on whether you're talking about 10 a.m. or 2 p.m. as to what the market is doing. Some days in the market, there's a wide enough swing that total swing is actually a pretty good year some years. So we're just kind of faced with that. But the key message is that I don't know about you, Ken, but I just had a deja vu moment when I'm sitting here looking at a stack of stock studies with return forecasts in the 20s and 30s, some in the 40s. It just reminds me so much of 2008 and some of our morning phone calls.
Well, it's even closer for me, Mark. I'm just thinking back to the depths of that really short V-shaped down up we had in the market in 2000. Was it 20 or 19 when COVID came and we closed and then we reopened and we had that sharp rebound up? I can remember going to an investment club meeting at that point and looking at a portfolio of 17 or 18 stocks that we owned, another half dozen that we'd like to own, and finding 22 or 23 of them saying buy. The same thing is happening now. We have a meeting tomorrow for our Wolves Investment Club, and as of the end of the market yesterday, we had 16 of our 19 stocks in the buy zone. So I just wish we had more cash. That's the only thing we're going wrong with right now. Mark, we do have a hand in the air, and her hand went up right as we started the program. So let me unmute Joyce and see if Joyce has something to offer to the group here. Joyce, you're unmuted. Joyce Lund, you're unmuted.
Yeah, Joyce is a longtime Chicago contributor.
Yes, I am.
Well, good evening. Good to hear your voice.
I was taking a nap.
Okay. What's on your mind now?
We're up in northern Illinois.
Uh-huh.
An inadvertent hand, maybe, huh? Okay, I'm going to take that down, and we have one other hand, and that's Dean Alden, our friend in the OKI chapter. So, Dean, you're unmuted. Go ahead.
That was a butt call.
A butt call? Okay, well, we'll take that hand down also, Dean. Okay.
Well, it's a pleasure being butt dialed from Cincinnati also.
All right. So, Mark, why don't you continue on with the housekeeping here then.
All right, we'll do our housekeeping. Again, the boilerplate, no investment recommendation is intended. This is an educational demonstration. What it really boils down to is tonight, Ken and I, usually it's 4 or 5 of us, but tonight we're going to share an idea and basically take that idea through an analysis that illustrates the methods of the modern investment club movement, championed by NEIC, Better Investing, and interpreted by Manifest Investing. So basically, we've been doing this for 8 decades now, at least the association and the legions of successful investors, some more than others. There are no guarantees in this, but this is how we look at stocks. This is how we build, design, and manage portfolios. So you're going to hear our opinions. Please do your own homework regarding anything that we talk about here tonight. If we hold a stock in actual real money portfolios, we try to disclose that. If you'd like to be added to a reminder for this list, send an email to nkavula1@comcast.net. Just simply tell her I want to be on the roundtable reminder list. And if you have any follow-up questions or would like copies of the slides or you have any suggestions, our 2 email addresses are there at the bottom of this page. Mark R. at manifestinvesting.com, kavula1@comcast.net, and we'd be happy to hear from you and do what we can for you. All right, here's kind of our standing agenda. We are going to take a look back at how we've been doing. Welcome if you're new. We do keep track of the performance of the stuff that we talk about. We don't have too many stocks on the hot seat because we're kind of at the opposite end of that type of a mentality. When prices are dropping like this, not very many things are quick to sell. Ken's going to cover Fox Factory again tonight. That's a repeat selection. In fact, Alphabet Google is a repeat selection. And if you were with us, I don't know if you'd be going Ardelyx or not, but Kim mentioned Ardelyx and Dow and Visa along with Copart as things that she was thinking about, but it's unfortunate they were unable to join us. We will hold an audience poll and leave time for questions if we can. The book on the right there is one that we covered during the bull sessions during the early days a couple years ago, and we may go back and visit a little bit, but I'm going to spend a little bit of time with Google. Here's just a quick reminder. We're just here to talk about an idea and how we analyze and assess that idea. And we do welcome non-core selections. One of our infamous, hopefully someday famous selections is the current Ardelyx position. It's a company without any earnings, and so it can't be core. It's got to be non-core. So we'll talk a little bit about that one. The goal of everything that we do here is to maintain a portfolio that beats the market by 5 percentage points over the long term. And we'd like to see the majority of our selections actually outperform the market also. Here's a quick, we talked about this last month, but since we are going to be talking about this book at next week's bull session, Ken, I think you might want to again do a plug for your new buddy, Morgan.
Well, I read this book a couple weeks ago, folks, The Psychology of Money. I enter into the reading of these financial books with a little trepidation. I'm usually not very impressed by a lot of the books that just kind of go on and on saying kind of obvious things, but I found this book to be, first of all, a very enjoyable read, an easy read, because this gentleman is such a good writer. And this book is kind of divided into 12 or 13, I would call them essays rather than chapters. He takes an idea and does a pretty nice full round trip on the idea and what it means to an investor. And then tries at near the end of the book to tie a lot of these ideas together. I think he does a pretty successful job. I felt like I was reading it on my Kindle, and I felt like I needed a paper copy of the book because there were just so many places that I wanted to run a yellow marker so I could go back and grab it and use it in presentations that I make. This is one of the quotes that especially resonates with me because Mark and I have talked about very similar ideas for the last couple of years about how you don't have to hit a whole lot of home runs to be a successful investor. Housel says that Buffett has owned between 400 and 500 stocks during his lifetime, the different names of different companies, but most of his profits have come from about 10 of those stocks. I did an inventory about 2 months ago of my own portfolios, and I find my numbers to be relatively consistent with Buffett's. I've owned between 300 and 400 stocks in my investing career, going back and checking my records and everything. But most of my profits come from about a dozen stocks. So I think that that's really important to understand that there's a definite downside to the purchase of any stock. You know, it can go to zero, but there is no upside. There's no cap on how much money you can make from a really great company if you buy it at a good price and hold it for a reasonable amount of time. So I would urge you to read Housel's book. We're going to spend some time in the bull sessions on it next Tuesday and maybe the Tuesday after. I think you'll find him to be an engaging writer. It's an easy and enjoyable read, and the book's not that expensive if you buy it either for a Kindle or you buy it as a used copy for something. We're talking literally $15 or less for the book. So
Yeah, it's been out a couple of years.
There's my plug. Okay, Mark?
I'm going to have to tally up my number of stocks because I think over a lifetime, including a number of investment clubs, I don't think I get anywhere near a couple hundred, but I'll have to take a look. I know Hugh McManus had done this in the past, where he went back and inventoried every single decision he'd made over the last 40 years in his case, and kind of interesting. All right, here's how we're doing. Interestingly enough, we have continued to slide along with everything. The rate of return is now down to 14.1%, but so has the market. So the market has dropped down to 8.6, which means that we've actually gained ground during this sliding market. Our relative return, that's 14.1 minus the 8.6, comparing the results of our decisions versus what if we had just invested in the Wilshire 5000. And we've achieved a 5.5 percentage point advantage at this point. That's the number that you see out on the far right there. So again, we have to be in a celebratory mood here. This is the 5.5 right there, and hopefully we can stay there and maintain over time. About half of our selections have come in and beat the market, so doing fairly well there too. Any comments on that, Ken?
I just think it's an extremely interesting graph, and for amateurs to be able to do this over a 12 plus years, I think says that with a little bit of knowledge and a little bit of discipline and some patience, I think it's doable for almost anybody to come up with a portfolio that at least can match the market. And as we're showing right now, this tracking portfolio for the last maybe 4 or 5 years now has pretty consistently beat the market.
And it is important. I mean, it wasn't that long ago that this rate of return was hovering closer to 19% since inception. So again, the relative return concept kind of keeps you grounded. Very important for individual investors and investment clubs to keep that in mind. Now, I realize you don't spend relative return at the grocery store, but over the long term, you do.
Fascinating, Mark, that at our 5-year point, we were just concerned about staying above zero. So
yeah, and I was getting a lot of credit for some of those bad results too. Undue credit. All right, here's a look at the tracking portfolio itself. This is the dashboard that we maintain. There's about, I would say, 70 or 80 active positions in the portfolio, and you can see the entire portfolio using that internet link down at the bottom of the page, but these are the top 20 by percent of total assets. So the 20 largest positions. And I was listening to the guys over at the compound, Josh Brown and Michael Batnick, talking about how much of a drop Microsoft has undergone. And it's just kind of cool to see that it's hanging in there for us. And if it's dropped that much, I certainly haven't felt it. But so these are our top 20 positions. The way you break down this chart is anytime we make a decision, whether it's a knight, a damsel, or the audience, we invest $1,000 into that company. So in the case of Microsoft has actually been selected 5 times. That's what this legend is for. So $5,000 invested in Microsoft has become virtually $60,000. So that's what Ken was talking about, how there's a lot of upside to stocks and can only go down 1,000. And so you can use that legend up at the top to see how many times a particular stock has been invested in. I'm going to be featuring Google tonight, so that will move up to the 11 position. You can see that our $10,000 invested in Alphabet or Google has basically doubled. So we're just adding to that. And Ken, you haven't selected Fox Factory enough to get it on the chart yet.
No, this will be the second time tonight. Mark, I'm noticing some new names, and I notice that a lot of times we tend to talk in shorthand when we do programs, whether they're for better investing or manifest or just investing in general. So I'm going to have us answer a few of these questions as we go.
Absolutely.
And they're coming from new names to me. Cheryl wants to know, what exactly is the Wilshire 5000? And do we invest in similar stocks?
All right. Do you want me to take it?
Sure.
Yeah, the Wilshire 5000, just as the name implies, is an index built from 5,000 stocks. Now, there's not actually 5,000, but that's a story for another day. But the Wilshire 5000 is basically regarded as a measure, one of the measures of the total stock market. The reality is because the companies that are largest, like Microsoft or Johnson & Johnson or Exxon, actually it's a cap-weighted index. So that means that those type of larger companies, Amazon, it would be another one, or Coca-Cola, they tend to dominate the performance of that index. So it's going to actually track pretty closely to the S&P 500, which is 500 relatively large companies also over time. But we do use it as a measure of the market. And yes, I would have to say that probably 95 to 99% of the stocks that we have picked are within the Wilshire 5000. I can't think of one that probably isn't. Ardelyx might not be there yet, but it probably is.
We have a question, and forgive me if I butcher this name, but Sriram wants to know what happened in the first 7 years of our journey here, Mark. We didn't do terribly in the first 7 years. If you'll notice, back at year 3, we were right about at 0. And remember, 0 doesn't mean 0 return. That means 0 relative return. So at that point, we were matching the stock market pretty well. And if the market had gone up, 12 points during that period of time, then we would have gone up the same 12 points or so. We don't have the entire graph on there, only for space reasons, but we didn't do terribly at any given time. And that leads us right into the last question from Linda. And she wants to know what exactly, in real simple terms, real slowly, is relative return again. So could you do it real slowly for Linda, Mark?
Okay, the concept of relative return is just simply the answer to the question, how did my decision do? How did the stock that I purchased do versus the stock market? In other words, in this case, we're saying, what if we had just taken the $1,000 and placed it? Let's talk about Amazon. Amazon. Now let's talk about Costco. That's a one-time selection. So with Costco, we put $1,000 into it. What if we had invested that $1,000 at the same time into the Wilshire 5000? And we're basically just comparing those two conditions. So you look at the rate of return that your investment has achieved. That's what the 14.1 is here. That's for the total portfolio. Okay. And you compare that versus what the Wilshire 5000 over the same time, the same $1,000 investments has done. And it's literally just 14.1 minus 8.6 gives you this number. And that's an exceptionally good number. Anything from 0 to 5 is really, really good. Anything above 5 is pretty rare. So we're doing quite well to achieve that 14.1%. So in the case of Costco, for example, that one-time pick, you won't find Costco up here in the tickers up at the top. That's because Costco has been selected one time. And $1,000 invested in Costco is worth about $10,000. If you actually looked at what would $1,000 invested on that day, and that's almost 10 years ago, into the Wilshire 5000, what would that be worth? The answer is probably closer to $6,000. So the $10,000 in current value for Costco is quite a bit better than the $6,000 that would have been realized investing in the total stock market. Hopefully that gives a little bit of help there.
Okay, and they lead right into the other questions. Cheryl is just cementing her understanding, and she says, does that mean around 2003 or around 2005 that you got exactly what the Wilshire 5000 would have given you with the same dollar amounts invested? And you're reading that exactly correct. When this graph hits 0, so around 3 and maybe in 2004, there's another 0, and in 2005, there's something close to 0. And all of 3 of those years, we were getting exactly cumulative what the market would have given us during that same period of time. Since 2005, we've managed to stay better than the market. And currently we're above this red dotted line right here. And the red dotted line is there, Cheryl, to put us kind of in memory or in thought of the basic goal of an investment club. When you start better investing, learning about better investing, one of the first things you learn is that if you could do your portfolio, if you could make it return about 15% a year, then it would have a doubling of your money every year, every 5 years effect. But more importantly, that 15% is sitting about 5% above the historical stock market average. So if you can do 15 while the historical market does 10, then you're doing that, doubling your money every 5 years that Better Investing talks about. And that's just represented by that red dotted line. We're a little bit above that right now, which means we're doing better than +5. And you can see the actual figures up on top there. We're actually doing 5.5. I think that brings us, last question. William wants to know what happens to all the dividends that are coming from this portfolio, Mark?
They're all reinvested into the original stocks. So it's a reinvestment type situation. It's a total return type situation. The only other thing I would point out, Ken, is these are years of operations. So this would actually be like 2013 right here, 3 years after the start.
Oh, that's a good point, Mark. Right.
Yeah.
This is
So that's
our third year of existence, right?
Third year of existence. And in the stock market between 2010 and 2012 or 2013 actually did pretty well. I would guess somewhere in the range of 16% per year, and we actually matched that. So that is an important point to make, that we weren't doing poorly. We just were not beating the market at that point. Okay, good to go, Ken?
I think we've caught up. We're getting lots of thank yous from the people that we answered questions on. So let's continue, Mark.
Okay, one of the other things that we do to check the portfolio, and I think I'll leave this to you, Ken, since the report card's up at the top. This is how we basically subject the portfolio to what we call a challenge or a audit, if you want, process as to what is there anything that deserves to be on the hot seat and be thought about as a potential selling consideration. So why don't you take us away?
Well, I would focus on the kinds of stocks that are on that list right now. I would consider at least 4 of them, and maybe all 5 of them, to be core stocks that fit our model, up straight and parallel model, with good consistent growth in sales and in earnings. We usually say that we will not consider moving those stocks out of the portfolio until the par value reaches something less than you can get in a money market certificate. And it looks like right now a money market certificate is yielding about 1.25%. I think that's the graph at the bottom is what it's demonstrating. Am I right, Mark?
Well, that's just an informational 5-year treasury yield. So that's actually at about 4% right now.
Okay. All
So
right.
we tend to think of them together as, cousins.
So I'm looking at First Financial, and that's the only one that comes even close. And I don't think it's close enough to get rid of it. So I think that we just maintain the portfolio the way it is right now. I'm looking at our numbers up on top right now. We have discovered that trying to maintain a portfolio in the sweet spot, when the sweet spot takes off into the 20s, we have discovered that you're continually playing catch up trying to do that. Our par is 18.6. That's pretty darn good. It's almost there. It's within half a point, and I'd give it a pass, an A minus or a B plus, and I'd say to myself, I would like to maintain pars at that kind of lofty valuation if I possibly can. But I know that as the market takes off, and it will take off, folks, sometime. I don't know if it's 1 month from now or 6 months from now or 1 year from now, but this bear market will end. I'm predicting that. I'm just not giving you a date. Quality for the portfolio is great. Earning stability and financial strength. You aim for 75th, 80th percentile, somewhere in there, and you're happy if you can get there. Growth, if you can keep your growth somewhere in the 11.5% sales growth or above, you have a really good chance of making all the other numbers. Right now, our growth is exceptional. So when these stocks in this portfolio start moving to the upside, when the bear market finally has an end to it and the bulls will eventually be back in town, then I think the portfolio is poised to really move us up there pretty quickly into some perhaps near the top of the sweet spot, which right now is 24%.
Good stuff. Okay, well, let's keep going. I would agree. First Financial is definitely a high quality bank that's done extremely well. The reason the return forecast, the projected annual return, is low is because it's done extremely well. Price.
Yeah, I'm going to answer one more question from Cheryl. Okay, Mark?
Absolutely.
Cheryl, this my par number right here. Think of manifest investing, and that's the tool that we're using tonight. Think of manifest investing as doing an SSG on every single stock in the database, and then telling us the par value, the potential average return for each of the stocks in that database, and in fact, ranking them from highest return to lowest return and pointing us to the median, to the exact middle. That's what MyPar is. Normally, MyPar on an average year should be somewhere around 10. On these years right now, when the market is undervalued, and that's what MyPar is telling us at least, MyPar has moved up to 14. Mr. Nicholson, who helped found Better Investing and who Mark and I really admire and follow his workings pretty closely, he suggested that beating the market by 5 points was doable. And hence you get the bottom of the sweet spot, 5 points above average, 19.1. He also suggests, however, that beating the market by more than 10 points is almost impossible. And hence you get the top of the sweet spot, 24.1. Now, if you can squeeze 25 out of that or 26 out of that, nobody's going to fault you for going above the top of the sweet spot. But we think realistically that this is a great target to aim at, to try to get somewhere between 5 and 10 points out of your stock in stock price appreciation plus dividend, to get that out of every one of your stocks, or if not out of every one of your stocks, to get it out of the entire portfolio. So that's our goal, to hit somewhere into that sweet spot. Right now, the anticipated goal based on our stock studies is 18.6%. So we're a little bit low. We're beating the market by about 4.5 points. That's great. You know, if you can only beat the market by 1%, that is statistically significant. That's doing what most mutual funds have a very difficult time doing. So to beat it by 4.6%, that's great. To beat it by 5 to 10 points is really great. So
Nirvana.
that's where all these numbers come from, and they all tie together. And if you talk about them on a regular basis, then you start to put them into your psyche, and you start to tell yourself, I know where I'm going, I know what I'm doing, and most importantly, in times like this, I'm not as fearful as I might be if I didn't have a methodology to fall back on.
Yeah, and I might just wrap it up by circling back and just pointing out that we believe that the most important characteristics of investments and portfolios are these three things. You think of it as a purpose-driven situation where the purpose is to generate return. That becomes objective number one. You want to make sure that is an appropriate number. You also want to have an appropriately high level of quality. And again, that's a weighted average of the companies in the tracking portfolio. So that's condition number two. That is the thing that actually serves as an insurance policy against this type of a nasty market, because those stocks will actually be buffered and protected a little bit. Third element, you got to have enough growth. And as Ken was saying, 11 or 12% is good. More isn't necessarily better, but sufficiently high enough is generally what we're aiming for. So those three conditions, when it comes to portfolio design from a purpose-driven standpoint, are really what we're doing.
We have Piero out in the audience, Mark, and he says, since we're going into a recession, should we be making different kinds of stock choices, and should we be maybe getting a larger cash position? I think, Piero, the beauty of the Better Investing system that we're following, the George Nicholson system, if you will, is that you're not buying the market, you're buying individual stocks. And we're going to keep looking for individual stocks that have appreciation potentials that fit into this idea of beating the market by 5 or 10 points. And we're going to continue to watch for those stocks, and we're going to stay relatively fully invested as we do it, because we know that some of the worst mistakes you can make are to hold large positions in cash when stocks are on sale. And that's one of the lessons that is the most difficult to teach people. If I asked you to go out and buy a car, you might be out there looking for your best deal in a car. And if you found a dealer that was offering 30% off on all the cars on their lot, you might at least check those cars out. We changed the word car to the word stock, however, and people get fearful. They hoard their money rather than to invest on a regular basis. One of the primary goals of better investing, one of the primary bedrock ideas is to invest regularly. Now, if that means once a month, then do it. If that means once every 3 months, then do it. But put your money on a regular schedule that you're going to invest, and then invest it. Don't try to time the market. And your question certainly smacks of a little bit of market timing right now. None of us is good enough to do that. And therefore, those of us with experience try to avoid timing the market. Mark, what do you want to add to that?
Yeah, the only thing I would add is I think it definitely makes sense to ratchet up your quality and perhaps the financial strength during these moments. So, but continue shopping for stocks that are on sale that are excellent companies. I agree with that. The only other exception is just a 15-second nutshell. If you happen to be an individual that's within 5 years of life expectancy, there could be different considerations that come into play with respect to cash reserves. So just a different situation. All right, here's a quick look at companies that are trading significantly below. Here's that relative return playing back at us here. I left the companies on there from last month's roundtable so you can basically see the progression from month to month. And we're just basically keeping an eye on these companies. They are dramatically underperforming the market. Again, it's a relative return, so we're watching these here. Now, we've kind of given our Delex a pass as a very special situation. We'll talk about that in a minute. But anytime a company drops down, we will do an analysis. In the case of PayPal, Adobe, particularly MKS Instruments, and a couple of those others, don't see any reason to run for the hills, even though they have fairly dramatically underperformed the market since their time of selection.
I think another thing, Mark, that's important to say is that in this last 9 months of market history, companies, from my point of view at least, have been unduly rewarded and unduly disciplined when they've either beaten their earnings numbers or come up short of their earnings numbers. I just can't remember another time in the last 35 years when a company can make a mistake for 1 quarter in earnings and lose 15% of their value in the space of a half an hour in the market. That certainly points to Adobe. I will call that one out for special consideration. Adobe had some real issues with its last earnings call, and it was pummeled. And I don't think the company changed as much as the market wanted to tell me that it had changed between the time that it didn't report earnings and then did report earnings, especially if you listen to the earnings call and then you look at the trend of some of the values that we follow regularly for our companies. So down 26%, I guess I'd be looking at Adobe and saying to myself, this might be a wonderful time to be accumulating rather than to be selling it.
Yeah, and that's the difference. I mean, Hugh McManus talked last month about running towards a burning building or a stock, but only if it's an excellent company that knows where the hoses and fire extinguishers are, because they'll come out of that fire and rebuild and be okay. But if it's a company that doesn't know where the fire extinguishers are, you have to be able to make that distinction. How's that for a metaphor, Ken?
I think it's a good one. It's the same one that we used back when we were talking about mattresses 10, 12 years ago, Mark. So
Absolutely. The other thing is we will watch is you'll hear on CNBC or Fox Business, they'll bring on one of the institutional analysts. We call them rhinos. And they'll basically talk about stocks being overbought and oversold. And we're just simply keeping track of that. And one of the ways that the industry keeps track of that is to do a thing called a relative strength index. It's completely based on the price. And anytime that relative strength index, that RSI, goes above 70 or 80, that's thought to be overbought, possibly an opportunity to sell. So if you're looking at a company and you find it above 70 or 80, it can be a selling opportunity. The inverse is true below 30 or 20. So when it gets down in here, and what you're seeing here is a whole bunch of stocks, I think our portfolio is extremely well positioned in this regard. Those are very low relative strength indices. That it actually rhymes with what you were just saying, Ken, about Adobe. Have the rhinos overdone it on Adobe? The answer is quite possibly yes. And Little Fuse is on here too. I just think that anytime relative strength indices, RSIs, get down below 20, I think it's worth a lot of attention. I mean, for a long-term portfolio, I think I'd be taking a really long, hard look at this one, FDX. Probably worth a look. And there's a couple others on there that are, but again, nothing. There's nothing at the other end of the spectrum. Nothing overbought at this time.
I'll tell you, Mark, that the Mid-Michigan Model Investment Club went back into FleetCor about 2 months ago. And this was part of the reason that it just appeared to be so much of a bargain. It's one of our favorite stocks. It's in, well, you can study what it's in, what it does. But we had been in it for a long time, moved out of it maybe 2 years ago, and now we're moving back into it. Notice the differentiation. Maybe you don't have the prices on there, but the price was just enticing, just too great for us to pass up.
Yeah, that's well, the price here is here. Current price level is right here. All right. Our quick Ardelyx moment. That is our large special situation position. The story's still intact. That's the way I would present the story. They do have a big meeting attempting to get their drug back on the approval path in mid-November, and that is still a work in progress. They're doing a lot of work to get ready for that. The Ardelyx in a nutshell is just like it says down here, is attempting to come up with a solution for chronic kidney disease and the control of phosphorus in a dialysis patient. And a lot of good feedback out there. They were actually on a warning about being potentially delisted. That has gone away in the last month. They stayed above $1 for the stock price for enough days that they are no longer on that list. And other things that have happened, there is some strong institutional interest. This Deep Track Capital actually bought $15 million in a single purchase. So there is some institutional interest there. And here's the CFO of the organization just basically pointing out that that they're getting ready for this meeting with the FDA. So nothing has really changed. You can see that the target price has not drifted at all. There's a number of people that would not be surprised to see this stock go to something like $6 virtually overnight. If it does that, it'll greatly benefit the roundtable tracking portfolio. All right, so we can come back to that if we need to later on. For now, Ken, why don't you go ahead and take us away with Fox Factory?
I'm answering a question right now, Mark. Give me just one question.
I'll give you a second.
Okay.
Ridefox.com.
There we go. I did this company last month, and I was looking around and well, do a click, Mark, if you would. And the first thing I pulled up was the roundtable portfolio, and then I focused at the very top of the sweet spot and the very bottom of those stocks right above the sweet spot. Those are the ones with the gold background. When they're very, very close to the sweet spot, I think those numbers are still believable. As they get further from the top of the sweet spot, the numbers might become a little bit unbelievable, all the way up to probably too good to be true. But when I'm looking 3 or 4 above that dividing line, this is a place that I really like to invest in. And Mark will tell you that he and I never discuss our choices before we make them. But I was seriously considering the stock that he is going to present tonight. That's Alphabet. I also really liked NVIDIA, but what I don't like are the analysts' conclusions about what's going to happen with NVIDIA. So I decided to avoid an internecine war and leave that one alone. I own UFP Industries. I own Littelfuse. I own Installed Business Building Products. And that led me finally to say, why not take and put a little bit more money into Fox Factory, since we only have a single holding in Fox Factory. It was brand new last month. So click if you would, Mark. So what does Fox Factory do? You can read it for yourself. And the important word in this whole slide is race. These folks make parts for people that are really, really into racing. Now, whether they're racing with 4-wheel vehicles or with 3-wheel vehicles or 2-wheel vehicles, or whether they're racing on land or on water, Fox Factory tends to make high performance parts for these different kinds of competition vehicles. Click if you would. A normal customer would be at the bottom of this triangle, a normal customer in a normal company. Most of you know Polaris, for example, and Polaris is not interested in pulling in the person that lives and eats and dies by his racing ability on his vehicle. They're a general consumer. But Fox Factory tends to go after the people that consider themselves professionals, and then those people that are right next to professionals, the ultra enthusiast, perhaps the person with not quite as much talent to be a professional, but they do everything else that a pro possibly could, and then the hardcore weekend warrior. Their customer is at the top of this triangle rather than at the bottom of the triangle. Next slide. It's an aspirational brand. You get points if you have this brand in your vehicle, whether it's a bicycle or a truck or a 4-wheeler. And you get bragging rights if you have thus and such with the right brand name on it. You've all played that game before, whether it's shoes or whether it's high fashion or whether it's makeup. There are certain brands that bring a cachet with them, and Fox Factory brands for these kind of weekend warriors, that's what they're looking for. They want to show everybody that they're playing with the best that you can possibly play with. Next slide. They operate in 2 divisions. The first is specialty sports. Next slide. And you can see some of the things they make in specialty sports. We might be content with a wheel that we could buy from the local hardware store or the local bike shop. but they're looking for a very special wheel that allows them to operate in a certain special way. Maybe they're looking to put a fork onto their bicycle that will allow that bicycle to absorb a lot more of the ups and downs, the bumps on an off-road course. You can see the kinds of things that Fox Factory makes. Next slide. The growth is in market expansion, brand new emerging segments. They do a lot of R&D, and they spend a lot of money doing R&D to innovate some of the sub parts of some of the major pieces of these different systems. And then they make an attempt to integrate the systems. And then, of course, they are there to sell you complementary materials to what you already have on your bicycle or your four-wheeler or whatever it is. Next slide. Second operational group is powered vehicles. Next slide. And again, there's significant penetration going on right now. They are moving from vehicles that ran in the summer and the fall to vehicles that run full year round, and to vehicles that run in the snow right now. They're becoming 4 seasons. Growing penetration in the OEM markets, the original equipment manufacturing markets, and then they're moving into additional opportunities. Notice they mentioned the military, and they mentioned commercial trucking. These are relatively new markets for Fox Factory. Next slide. You can see that the businesses are split pretty much 50-50, and the way Fox Factory does its business is they come up with a part to start with, and that part goes into manufacture and moves into the population in the aftermarket. And eventually, when it becomes extremely popular and it's being demanded by consumers all over, it becomes part of the original equipment manufacturing, and contracts move then to the OEMs from the retailers. Next slide. Great growth being predicted by the company. The most recent quarter showed 23% growth, and we'll be seeing on our visual analysis what that growth looks like. Next slide. One more slide, Mark. There we go. In August, I showed you the picture in the upper left-hand corner. In September, the picture hasn't changed. Not a new quarter. Nothing's fallen into the graph, but the price has sagged a little bit. There doesn't seem to be any reason for the price sag. You can see the red tick on the August graph, and then you can see where it is closer to the bottom on the September graph. I've rethought my forecasts for sales and earnings, and I think they're still extremely reasonable at 15. I like the profit margins basically staying above 14%. Return on equity around 20. That's an excellent return on equity. And debt to capital numbers in the acceptable range, under 30%. Next slide, please. Value line suggests earnings out to maybe 17%. I like this last paragraph in the July 29th value line, so I copied it and put it in the presentation for you to read. And again, the only thing that's really changed from last month to this month, the value line's the same, the visual analysis is the same. The only thing that's really changed is the price has gone from about $97 to about $77.50. The stock has moved right with the slide, the swoon in the market in the last 30 days. Next slide. using sales growth of 15 because I'm convinced they're very reasonable. I did take my PEs down. If the market is going to revalue these companies, then I moved my high PE from 35 to 25. I moved my low PE from 16 to 12. And you can see that last month I was getting a buy, and this month I'm getting a buy. I'm looking at projected return around 16%, 16 to maybe as much as 23%. I want to say that I think this is an extremely conservative SSG that I'm doing this month. Taking those PEs down as far as I did, still getting a buy with nice return values, I think says that I'm looking at a very high quality company. It keeps appearing on my different screens that I do. It keeps appearing on the screens Mark does. And I'm convinced that there's something here that's going to be a great investment. And I'm just going to have to be patient if I put some money into it at this time. One more, I think, slide, Mark. Fox Factory, Manifest is suggesting par up to about 24%. That's near the top end of my SSG. Manifest suggests that Fox Factory is the top in the recreational vehicle industry. Just for your information, Morningstar puts Fox Factory into the auto parts industry. And I think it plays well with all 5 of those auto parts companies that are listed right there. One more slide. Manifest even suggests that Fox Factory might be the top company in the entire consumer discretionary, or sometimes it's called consumer cyclical sector. In the entire sector, they suggest that Fox Factory might be number 1, or at least up there in the top 5 somewhere. So I'm suggesting another $1,000 into Fox Factory. And if I can get the audience to vote with me, then we'll have 2,000 going in there.
Well, thanks, Ken, for not saying that if we liked it at 98, we got to really like it at 78.
No, I don't. Not necessarily.
Also want to thank you for not falling in love with another CEO.
Okay, all right.
I don't know. This slide just won't go away. For some reason, it won't let me delete it. The Portillo's menu. By the way, Portillo's is the best performing stock from 2 months ago.
Is that why it won't go away, Mark?
Yep, pretty much.
I figured that. Okay.
All right. I actually resorted to something fairly simple, recognizing that we are in a nasty bear market, and I decided to do something pretty simple, and that is go for extremely high quality companies with decent return forecasts. Those two things actually combine to form, these two characteristics combine to form this manifest rank. So I'm basically saying I want to just see the companies that are in the top percentile, the top 1% of all companies that have high quality and a high return forecast. On top of that, I'm going to say just show me the triple play candidates. And we'll talk about Alphabet as a triple play candidate. And then again, coming out of a recession or a bear market like we're in, the smaller, faster growing companies typically heal faster and can actually do great things. So I wanted to stick with double digit growth. So that's what this screen is based on. I'm going to stick really simple with the very first one on the list, although I really like this one too. I do think that there are global problems with a few of these along the way. Intrigued by the gold. Here's one that Ken pointed out that actually looks kind of compelling. Might end up on our best small company list, MP Materials. Might be worth a look. And lo and behold, this one's showing up here on this list. And MKS and Floor & Decor also. But I'm going to stick with Alphabet. Quick reminder what the triple play consists of. Again, this stems from George Nicholson's advice, especially during deep bear markets, to look for companies that are well established, really solid performers over the long term that have 3 characteristics. The first is they're at a depressed stock price. And basically that is manifested by a high return forecast. So we see that here. And we also note that if you look at the price chart over the long term, there's been quite a dip down here. So yeah, the price is depressed from where it has been versus the long-term trend, and the return forecast is high. So the first condition is met. You also want to look for a situation where the current or trailing price to earnings ratio, in this case it's approximately 20, is lower than the expectation out here. And in this case, 20 is projected to go up to as much as 25. So there is room for some PE expansion. The third is we want to see an improving profitability picture. And this company basically average, we'll just take any one of them, but we'll take operating margin. Operating margins around 30% are projected to go up closer to almost 40% for Google. So all three conditions are met. This is a valid triple play situation. I like the diversity of this company. It is a technology company centered on their search engine, their advertising. They do a bunch of stuff. They are involved in a number of technological enterprises and explorations. They basically are just trying to harness technology in a number of different areas. So they are a little bit better diversified than some of the other technology companies. The other thing that I really like is they have twice as much cash on their balance sheet as total liabilities. So that's not just long-term debt, but total liabilities or total cash versus current liabilities. And that's a pretty good situation too. Here's a quick look at the business model analysis for the company. This is quality up here. You can basically see that it's lining in a really nice quality spot. Here you can see the return forecast. This is the par that is shown right here. That's this point right here. It's basically at an elevated level versus recent history. We're basically talking about a huge company, 278 billion in sales, continuing to grow in the upper teens. If it continues to do that, and the market is out there for the available market is out there to do that, we are looking at a company over $600 billion operating at a net margin somewhere in the upper 20s. And so they could literally be earning $12.91 with a PE of around 22.5. Do those seem reasonable? I don't know. If you look at the earnings trajectory here, it's clearly not out of the question for that number to be in the $12 to $13 range. When it comes to the PE ratio, something in the 20 to the low 20s is certainly very reasonable. That means that things do check out fairly well. Across the board, financial strength, earnings per share stability, that red trend line basically touches virtually every point, and it nets them a very strong quality ranking. The audit on the return forecast is given to us by the projected return on value, and again, a very strong profitability picture here. Whatever the business mix and whatever the enterprise is doing, it's operating at a very high level, somewhere near a 40% operating margin. So this number basically suggests that, yeah, this PE might be a little bit high, but it's certainly not way out of the ballpark. The buy below is 120-ish. This company is currently trading at just under $100 a share. Some other bullet points that are just real telling. They do have a little bit of debt. Their effective interest rate is a little bit above 2%, which means that the banks have an extremely high regard for basically the investment grade, or if you're loaning them money, you're willing to do it at a very low rate. So a lot of respect here. Company is trading basically at its 52-week low. So it's basically trading at a 52-week low. That's another plus in this type of a situation. The long-term low return forecast is over 20 for the company. So again, you've got Morningstar checking in with a price to fair value that says this thing is considerably on sale. The analyst consensus agrees. And we also have that relative strength index we talked about earlier below 30. So it's kind of hard not to like this. Very consistent price trend over the years. Doesn't get more up straight and parallel. down 36% from where it was. I just have a hard time not liking the situation. I checked. I do not actually own shares of Google. I will probably change that. I know that Ken does. So in the spirit of full disclosure, he does. So this is one that we have talked about quite a bit over the years, and it's been chosen for the portfolio 10 times. I'd like to make it 11. Any comments or questions, Ken? That one shouldn't be in there. I think we're ready to go to the poll.
Okay, you're only going to get 3 choices tonight, folks. So let's see if we can pull up the poll here. And there it is. So would you like to add an extra holding in Alphabet or in Fox Factory or in none of the above?
In other words, would you prefer to herd cats in Utah instead? Hey, I actually do. While people are voting, I actually have a weather report from Florida where Kim is. They're expecting up to 24 inches of rain. That's about as much rain as we get in a year, I think, Ken.
I agree, yeah.
She texted me she's safe and okay, but she's not sure that she has an umbrella that can handle 24 inches of rain.
I'm going to count to 10 in my mind here and then close the voting. We're above 90% in voting, and that's really good for an evening. If you haven't voted yet, just use your mouse and pick one of them and give us an extra vote here. So let's close. And we'll share the results. And Mark's going to be doing dances all over the room right now. 67%, Mark, want to put another Google holding in. Only 31% want to do Fox Factory.
Wow.
So we'll just have to wait with Fox Factory. And while I own Google and don't own Fox Factory, I do want a chance 6 months from now to say I told you so. So we'll hope. Okay.
That's kind of like my Portillo moment, right?
All right. Okay. Yeah, you can go back to. Well, let me close. Close the polls entirely. There we go, Mark.
All right. Thank you. Here's a reminder. People had asked, what can you find? What will it look like? If you go to YouTube and you just search on Manifest Investing Roundtable, you will see this page. You can see that we archive the bull sessions that we do every Tuesday at 2, in addition to the roundtable and a variety of other sessions if you go back over the years. And just, again, it's free. Consider subscribing so you're notified anytime that we add content to the page. And we appreciate you doing that. As far as stuff coming up, October Roundtable is about a month away, October 25th. The following weekend, we will be tackling the best small companies for 2023. Shameless commercial here. We are actually going through the hunt for those best small companies during the bull sessions for the next month. And Ken admitted today he's knee deep in best small companies, trying to track them down.
Ankle deep right now, wanting to be knee deep, Mark.
You're only ankle deep? Oh, I'm
only ankle deep right now. Okay.
And we continue to hold out hope that our best small company portfolio will equal or beat the Wilshire 5000, because we've done it for 7 straight years, and we're kind of at risk right now. For those of you in mid-Michigan, or if you want to travel in for a weekend, November 12th will be a face-to-face meeting. I believe that's in Saginaw, correct, Ken?
It's in Saginaw, and my board has decided that we're going to go ahead with it no matter what the number of folks are. We're just tired of doing things online. So we're going to meet you all for breakfast. And if there's only 7 of us there, that's going to be great. We'd love to see 90 or 100 as we usually have. So if you have a chance to be anywhere near Saginaw on November 12th in the morning, we're having a nice breakfast and then a full morning program up until about 11:45 or noon. and we'll be giving out our Stock Pickers Awards, talking an awful lot about investing and just having a really good time.
And then a
Mark,
few
we're
days
getting a
later-
question about the
Go ahead.
we're getting a question about the AAII program. Is that online or is that in person?
That is in person, and the details are just forming right now. AAII Michigan is having Christine Benson this in October, and Ken and I are going to be putting on that program in mid-November. There will be a lot more details here within the next few days on that event, and they were still actually locking down that event. Maybe it's a good sign that organizations are having a little bit of difficulty locking down meeting rooms these days. So we'll be thankful for that. So with that, I think we could probably go to any questions or any outstanding items, Ken.
I will tell you, Mark, that I've kept up with them pretty well this evening, and so I think we've covered the ones that are really hanging out there. So let's see what. Oh, Phil Sidor wants to know when I'm going to get my Fox Factory tattoo. He'd like you to make a movie of it and put it on the YouTube channel, Mark. Okay.
You know, we had you probably don't remember this, but we had a big deal with you getting a tattoo a few years ago that
We
people
did.
wanted footage. Yeah.
Oh well.
So it's a recurring theme.
I think it's going to happen. You know, kind of like when hell freezes over. So okay. So with that thought in mind, I'm going to tell everybody we appreciate you being here. We thank you so much for coming to our programs, and we'll see you next month.
All right. Thanks, Ken.
Thank you, Mark, for everything you do. Bye-bye.